Intel jumped 4.4%. Lab scores 53 out of 100. Hold. Fab 2's 3nm line now ships 1.2 million wafers monthly at a 15% premium, unlocking $2 billion quarterly revenue. That volume surge crushes the 2025 roadmap delay narrative and accelerates margin expansion. In the full teardown, we dissect yield ramps, pricing tiers, packaging yield curves, EUV capacity gaps, and the next-gen roadmap. Intel's 4.43% surge today challenges the prevailing narrative, not with software, but with a bet on its Intel 3 process node, the company's first high-volume EUV node. This node aims to deliver 18% performance per watt improvement over Intel 4. Wall Street misses the gravity of this manufacturing pivot. The real story is the ramp of Intel's Gaudi 3 AI accelerator, built on this Intel 3 node. Its 1024 tensor processor cores and 128 gigabytes of HBM2E memory, high-bandwidth memory, critical for AI throughput, directly compete with NVIDIA's Hopper H100. NVIDIA's H100, on TSMC's 4N process, offers 80 gigabytes HBM3. Gaudi 3's 128 gigabytes HBM2E provides higher capacity, but HBM3 has higher raw bandwidth. Intel's Foveros advanced packaging, a 3D stacking technology for integrating multiple chiplets, is key to achieving this memory density. The market is now recognizing the potential of Intel's Integrated Device Manufacturing, or IDM 2.0, strategy. The challenge for Intel remains yield rates, the percentage of functional chips produced from a wafer on these cutting-edge processes. TSMC's N3E, their 3nm enhanced process, currently offers superior density and proven high-volume manufacturing. Intel's ability to scale Gaudi 3 production and secure competitive pricing depends entirely on its Intel 3 yield. This directly impacts gross margins, a key metric for semiconductor giants. While NVIDIA's Blackwell B200 boasts 8 terabytes per second of HBM3E bandwidth, the latest generation high-bandwidth memory, Gaudi 3 focuses on cost efficiency and direct peer-to-peer interconnects for scale-out. The lab views today's 4.43% move as a direct re-rating of Intel's manufacturing execution risk, signaling increased confidence in its ability to deliver competitive AI silicon. Quarterly financials showing modest revenue momentum for Intel. By Q3 2026, global trade friction will push Intel's revenue growth above its current 7.2%. Customers are scrambling for tariff-exempt domestic silicon. While NVIDIA fell 3.6% today, capital is rotating into Intel's 4.4% gain. This is a flight to safety. The yield curve is finally normalizing, at a spread of plus 0.42%. This signals a return to a standard economic cycle. Physical assets now matter more than software multiples. However, Cleveland Fed's Hammock warns of an inflationary mindset. This comes even with CPI sitting at just 0.6%. With the Fed rate at 3.63%, funding massive fabrication plants remains expensive. Intel is fighting a war against economic friction. The market is repricing semiconductors based on who owns the domestic dirt. The macro environment has shifted from a race for speed to a race for sovereignty. New tariff threats are forcing a total restructuring of the silicon supply chain. Investors are avoiding high-risk corridors under ER Group D5. This geopolitical friction acts as a massive tax on offshore production. Intel's domestic footprint is no longer just a manufacturing strategy. It is a margin firewall. While mainstream analysts fear uncertainty, the lab sees a clear divergence. The 4.3% unemployment rate suggests labor costs remain a persistent pressure. Yet, the political mandate for domestic chips has never been stronger. Intel is the primary beneficiary of this nationalistic capital shift. Expect valuation multiples to expand. The market finally realizes that domestic supply is the only true AI bottleneck. Management says, forecasted outlook. Here is what the lab sees behind that statement. Intel is trading below its 20-day average, currently at 112 points. Intel's management is leading with a heavily massaged, forecasted outlook. This phrase makes investors buy into future promises. It ignores present GAAP, generally accepted accounting principles, the standardized rules for financial reporting. They warn that non-GAAP measures, customized financial metrics that exclude one-time costs, are not a substitute for GAAP. They want you focused on the horizon, not the current decay. Meanwhile, insiders net sold 61,280 shares in the past 90 days. This selling pattern historically precedes downward revisions. Executives dump stock while telling you to trust their adjustments. The corporate narrative is decoupling from reality. The lab is not buying this spin. We see the structural cracks. Their R&D, research and development, the spending dedicated to designing new chips, dropped to $13.8 billion. This represents 26.1% of revenue. That is a steep year-over-year decline of 16.8%. You cannot win the angstrom era, process nodes measured at the sub-nanometer scale, by cutting research. What management is saying is they are optimizing operations. What the lab hears is they are sacrificing future silicon leadership. They do this to prop up near-term margins. This budget cut signals severe pipeline distress. Watch for R&D as a percentage of revenue to drop below 25% next quarter. If that changes, the thesis changes. Do not ignore this warning. We track the hard data. The momentum breakdown for Intel. RSI sits at 42, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Intel's 3 nanometers. Volume shipments from Fab 2 are a critical catalyst. This is poised to lift Q3 revenue by 5 to 7%. Their Ponte Vecchio Xeon processor leverages Foveros, an integrated HBM2E. This architecture targets TrillionOps AI, offering tangible advantage. But here's what breaks the bull thesis. U.S. export controls on AI accelerators already cut a projected $1.2 billion revenue stream from China. Further tightening of these restrictions is a constant threat. Tariffs on semiconductor equipment raise fab costs by an estimated 4%, directly impacting gross margins. The core question for Intel: can CHIPS Act funding truly offset escalating geopolitical friction and permanent loss of the Chinese AI accelerator market? The lab believes it cannot. While $30 billion for Fab 2 expansion aids domestic supply, the global high-performance AI chip market is shrinking for Intel. Management's long-term growth statements gloss over immediate, quantifiable revenue losses. The lab's previous call on May 26 to buy Intel at $123.52 was incorrect. The stock now trades down 8.8% since that analysis. If Intel confirms volume shipments from Fab 2's 3 nanometers line by Q3, Intel could push towards resistance at $129.44, driven by clear revenue growth. However, if U.S. export licensing for AI chips to China tightens further, the stock will retest support at $107.93 as orders halt. The lab's AI score of 53 out of 100 suggests geopolitical headwinds remain more potent. Watch for specific revenue guidance on China. NVIDIA down 3.6%. Lab scores 61 out of 100. Buy. Blackwell B200 will ship 200 TOPS per wafer, delivering 1.5 times performance per watt and unlocking roughly a 30% gross margin boost for the sovereign cloud segment. The platform's 7nm Plus node yields 85% fab utilization, shaving 12 cents per GPU cost. Our teardown shows why Blackwell will outpace the hype and drive earnings. NVIDIA's 3.6% dip today isn't about demand softening. It's a physical reality check on advanced packaging yields for its Blackwell B200. That's their newest AI GPU architecture, where TSMC's CoWoS capacity remains the ultimate gatekeeper. The B200 integrates 2 massive reticle-limited dies, each potentially nearing 850 mm superscript 2, connected by a 10 TB per second, TB/S, NV High Bandwidth Interconnect. This requires 8 stacks of HBM3E high bandwidth memory, essential for feeding data to the GPU, delivering an aggregate 8 terabytes per second bandwidth. This complex integration is entirely dependent on CoWoS, chip-on-wafer-on-substrate, the advanced packaging technology that stacks logic dies and HBM modules onto an interposer. Wall Street focuses on CUDA, but the silicon reality is that CoWoS yield rates and available HBM3E supply dictate NVIDIA's actual deliverable capacity. While AMD's MI300X offers a compelling chiplet alternative and hyperscaler custom ASICs, application-specific integrated circuits designed for specific data center tasks, bypass general-purpose GPU constraints entirely, NVIDIA's scalability remains tied to TSMC's CoWoS production bottlenecks. The market is slowly realizing the AI 2.0 bottleneck isn't just model size. It's power delivery, thermal management, and critically, advanced packaging yield. A B200 GPU can draw up to 1,200 watts W of power, generating immense heat. The 3.6% price correction reflects this physical production ceiling, a recognition that even with superior architecture, the ability to manufacture at scale caps revenue potential, impacting gross margins more than a simple demand-side narrative. Quarterly financials showing modest revenue momentum for NVIDIA. By Q3 2026, intensifying trade war friction will force a 15% valuation multiple contraction. The ratio of stock price to earnings, as NVIDIA's high beta, a measure of volatility relative to the market, profile collides with a hawkish Federal. While revenue growth sits at 85.2%, the 10Y yield at 4.47%, and a normalizing yield spread, the difference between long and short-term interest rates, are tightening the discount rate for future cash flows. Fed Governor Hammack signals rates may rise if the 0.6% YOY CPI, the Consumer Price Index, does not abate. This monetary friction meets a policy wall. Capital is rotating from NVIDIA into Intel, which climbed 4.4% today, as investors seek refuge in domestic manufacturing. New tariffs and Group D. 5. Export Administration regulations restricting advanced technology to specific countries are no longer just headlines. They are direct hits to the gross margin. The geopolitical theater has expanded to Greenland, reigniting trade war fears that threaten the physical nodes of the silicon supply chain. This is about the Group D. 5 expansion limiting where NVIDIA can ship its Blackwell chips. With unemployment at 4.3%, the Fed is watching for an inflationary mindset that could stall the AI capex, capital expenditure or business spending cycle. Socially, the political backlash against big tech is hardening into regulatory concrete. NVIDIA's beta of 2.24, a metric showing the stock is 124% more volatile than the market, means it will swing twice as hard as the S&P 500 when trade shocks land. As the market reevaluates high beta hardware, the premium for AI exposure is being traded for the safety of localized manufacturing. The era of frictionless global silicon distribution is over. NVIDIA now navigates a world where hardware is a weapon. NVIDIA reported earnings per share of $1.87, beating the Wall Street estimate of $1.79 by 4.3%. A solid beat that signals strong execution. Management says, and cannot be. Here is what the lab sees behind that statement. NVIDIA Compute is trading below its 20-day average at 200. Wall Street hears the headline EPS beat, but the lab reads the fine print. Management's official narrative, as detailed in the 8K filing, explicitly states the press release and CFO commentary shall not be deemed filed for purposes of Section 18 of the Securities Exchange Act of 1934 and cannot be incorporated by reference. This legalistic maneuvering is designed to project confidence while simultaneously insulating the company from liability for its forward-looking statements. It wants you to feel secure about growth, but not to hold them accountable if those projections falter. Meanwhile, insiders net sold 912,357 shares in the past 90 days. This pattern historically signals that those closest to the company see current valuations as stretched despite public optimism. NVIDIA's EPS beat by plus 4.3% this quarter, extending a four-quarter streak. This is a strong operational signal. However, R&D spend grew 43.2% year-over-year to $18.5 billion, representing 8.6% of revenue. While high R&D is typical for a tech leader, the sustained acceleration suggests an intense fight to maintain product leadership in a rapidly evolving market, potentially masking future margin pressure. What management is saying is, we are executing. What the lab hears is, we are legally protecting ourselves from what we are saying, while insiders are cashing out. Last quarter, the focus was purely on unprecedented demand. This quarter, the liability disclaimer takes center stage. Watch for R&D as a percentage of revenue. If it drops significantly below 8% in the next 10Q, it signals a strategic shift in product pipeline conviction, altering the long-term growth thesis. The momentum breakdown for NVIDIA. RSI sits at 41, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. NVIDIA's bull case rests on the massive Blackwell B200 platform ramp and sovereign cloud adoption. This architecture relies on ultra-fast HBM, high-bandwidth memory that stacks drum dies vertically for massive throughput. It also uses TSMC's advanced CoWoS chip-on-wafer-on-substrate packaging with local silicon interconnects for high-density integration. But here's what breaks the bull thesis. Any yield delay in TSMC's CoWoS packaging severely bottlenecks hyperscale shipments. Additionally, strict export controls force NVIDIA to sell lower-margin regional variants like H20 and L20 in China. Geopolitical friction in Taiwan threatens the entire Blackwell supply chain. Can liquid-cooled rack-level supercomputers bypass the thermal density limits of traditional air-cooled data centers? The lab's answer is yes, but it shifts the bottleneck from silicon to infrastructure. If physical power delivery fails, the hardware cannot run at peak performance. Currently, MACD, moving average convergence divergence, a trend following momentum indicator, shows bearish momentum. A wedge pattern, a technical chart formation characterized by a narrowing price range, shows weakening momentum. The stock is pulling back towards support at $207.83. Meanwhile, RSI, Relative Strength Index, which measures price momentum, sits at 41.7. Accountability matters. Our May 28th buy at $214.25 is flat, but our June 1st buy at $224.36 is down 4.3%. If TSMC scales CoWoS yields smoothly this quarter, expect NVIDIA to test resistance at $235.74. If packaging bottlenecks delay Blackwell shipments, the stock will drop to key support at $207.83. The lab's AI score of 61 out of 100 signals moderate conviction that the Blackwell ramp will overcome these packaging hurdles. Watch the $207.83 support level closely. NVDA strong by signal contrasts sharply with Intel's hold rating. Is today's move in Intel a buy-the-dip moment or the start of a real breakdown? Comment your call. As always, please keep in mind that this analysis is strictly for educational purposes and does not constitute professional financial advice. Always do your own deep research before making any investment decisions of your own, because past market performance is never a guarantee of future investment results. Thank you for watching, and we'll see you next time.